Join us now on the meeting and how the Fed will process the collapse of First Republic Bank. Roger Ferguson, former vice chairman of the Federal Reserve, former CEO of TIAA, and a CNBC contributor. And it was so orderly, this process, and it was only, we're not seeing, it's not a centipede yet, Roger, in terms of the contagion. It's really almost unique circumstances for the banks, the three, however many you want to, attribute to this recent flux. But it's like, this might be it, right? And they're one-offs. All three of them seem like one-offs.
Well, good morning, Joe. I think the Fed and others want to position this as very much three unique situations, each with a business model that's not replicated other places. Right. I think it's important for them to say that. And they will use that basically to allow them to continue to tighten as the market currently expects. But
there are others, Charlie Munger among them, that there is a underlying issue with a lot of commercial property loans, and that could be, more systemic and a more widespread problem. But I don't know. The Fed seems, the way it looks is that the Fed feels somewhat comfortable about being able to go up another 25 basis points without really introducing more risk to the system.
I think you are right. That's the way the Fed sees it. I think they also know they've put in, this term lending program for banks, which is a special tool that they think is going to support the banking system. To what Charlie Munger had to say, I would have to say, he is not wrong that there are, across the banking system, many institutions that probably invested in commercial real estate mortgages, regular individual mortgages as well. And as we've seen, even in government securities, all of which were at very, very low interest rates. And now with rates rising, the mark to market on those has been negative. And so one cannot say that this is not, a problem that exists across the banking sector. I think the policymakers are certainly going to continue to say the banking system is safe and sound and solid. They're going to probably want to say that with this last move, they don't have that same fear of contagion. So I'm not rejecting Charlie's argument because I think it's factually correct. I think what the regulators are going to say is we've got this well ring-fenced now, and we can move on with fixing monetary policy with both eyes focused on inflation. We will see over time, by the way, if Charlie proves to be right. I'm not rejecting the possibility there'll be others because the balance sheets of many institutions are filled with assets that were priced for a low inflation, low interest rate environment.
I mean, in a competitive business, you do see different players, do things to gain market share that probably aren't that smart. And I think Silicon Valley is an example. First Republic, another example of that. And we always hear about the dumbest competitor. You're no better than your dumbest competitor. How much, though, was zero interest rates also to blame? Because we hear that criticism all the time, that you're going to have people move out the risk curve or companies move out the risk curve when they shouldn't, and they have this false sense of security that nothing's going to happen. How much do you blame the Fed for staying at zero for so long for these instances? Or is it bad management at the individual banks?
Look, when you have this kind of failure across bank institutions, there are many contributing factors. So certainly very low interest rates for a long period of time did force institutions to do what's called, stretch for yield, seeking yield. And as interest rates start to rise, those assets that you invested in at a low rate will lose their face value. So, I think no one would deny that having low interest rates for a long period of time was a contributing factor. Having said that, in each one of these cases, we had, as you point out, a unique business model that had its own inherent risk that could have occurred at any time. So it's not one thing drove all of this. It was an intersection of low interest rates, management seeking yield that perhaps they shouldn't have or in a way that was overly aggressive, plus a number of other one-off factors. Having said all of that, I'm still in a place where I'm with Charlie. I'm not sure this is totally over just yet. I hope that it is, but because of that point that we were just discussing, of many institutions having assets on their balance sheets priced for a lower interest rate environment, I think there is some risk that we have to continue to watch the situation closely.
Hey, Roger, no question it was bad management at these banks, different bad business models chasing after this stuff. But it was also lax regulation. Lax regulation coming from the very same institution that was raising rates. If they knew they were going to be raising rates, if they were watching what they were doing, wouldn't it have made sense to have much tougher regulation so that some of these activities at least were kind of called out?
Well, look, I think one of the things that came out of this report that they issued was, in fact, that they were not forcing very aggressively taking a look at asset liability matching, taking a look at interest rate risks. Some of their scenarios are much more focused on unemployment, et cetera, as opposed to interest rates. So as their report said, the one that the Fed released on Friday, they, I think, take some of the blame themselves for both supervisory failures and, this intersection of supervision failures and rising interest rates. So, I think they are doing a notable mea culpa in that report that came out on Friday.